So Azad, I think we are ready to start upon. Let's get started.
Okay. Um, Hello, good evening, everybody, and thanks a lot for joining this series of sessions that we are doing. The goal of this is to spread the financial education to everybody that is interested. My name is Azad Daramandla. I am in the Bay Area. I'm in the business of educating people on financial planning, comprehensive planning. Mr. Leela Prasad, who is from Samasti Indo-American Club. We are collaborating with them, and we are bringing this to Samasti so that anybody who joins Indo-American Club, go there and join. We will be spreading this financial education, and there is a series of lectures that we will be doing every Thursday evening at 8 o'clock for the next 10 weeks. And today is the first session. We have with us our guest, the professional Sanjay Muppaneni from Sanjay Tax. And Sanjay, thanks a lot for taking your time. I know it's a very, very busy time for you. It's just about a week away from filing the taxes with the extended deadline. And we really, truly appreciate you taking this time to come and talk to us, our viewers, and give some last minute tips or how to prepare for next year's taxes so that we all can benefit, people can learn a lot. With that, I request Sanjay to take the microphone.
Yeah, we can go to the slide. So this is Sanjay Muppaneni. I'm a CPA and IRS enrolled agent, doing tax filing and accounting for almost 14 years now. So I was a software engineer when I first came to US, and then I changed my career out of passion, and now we have multiple offices in Bay Area, and we serve clients all over US. And I tried to put something together with the idea that I can get something to the audience here. So I tried to tailor the presentation specifically to the audience here. And a small announcement, basically, we sent a message to all of you. So whoever registers can get a slide deck, the one I'm using here, later in the email. So please go ahead and register for the Samasti organization so you can get benefited with your financial knowledge. With that, let's get...
Go ahead, Sanjay.
Yeah, with that, we can get started. So if you can move to the first slide. So the most current thing, the CARES Act, I just put a slide on that. So if you are not aware of certain things, you can get awareness on the CARES Act that was introduced recently, given the coronavirus situation that we are going through. I hope we all will come out of this soon. So I hope you all staying safe. Coming to the CARES Act, which is Coronavirus Aid, Relief and Economic Stimulus Act. Basically, this was introduced to not only protect the economy, but also people who are suffering due to financial losses or job losses. So the first thing they introduced in this CARES Act is the direct payments, basically the stimulus payments which people are getting. So these payments are for people who are making income less than a certain threshold. So if you are single, your income threshold is less than 75, and then after 75, before you hit 99K of AGI, this stimulus payment keeps reducing. So it's $1,200 per person. So if you're married, the threshold is double. So somebody who's making 150K or less would get this. So initially, the criteria was if you didn't file your 2019 return, the payments were based on 2018 tax filing that you filed. And if you happen to file 2019, they would take that into consideration. So we were advising clients to see which year their income was low, and then based on that, though we prepared some returns, we were holding off them to not file because probably their income was higher in 19 compared to 18. so they would get better stimulus with the 18. So that was the strategy we employed. And for people with income whose income has gone down, we went ahead and filed so they get a better stimulus with the 19 filing. Even if you didn't get so far, you might get it based on 2020 filing again. So it's not that it's only based on 2018 or 2019 filings. Also, the other thing is of importance here, what if you never filed a return? Then on the IRS website, you have this portal where you can go and fill in your details, and you can make yourself eligible if you are, of course, there are certain criteria. Non-residents are not allowed to get the stimulus. Same thing if you're married and let's say your spouse has no SSN and she has probably something called tax identification number ITIN, then you're not eligible to get the stimulus. But that's a little controversial given they are residents and contributing to this economy. Some of these people are not getting, so which might be addressed if they announce another stimulus. But as of now, if one of the spouse who files a joint return has ITIN, then they don't get it. And also, if you did direct deposit because you had a refund last year, you should have received stimulus directly in your account. But if you had a due, because IRS wouldn't have your bank details, you would probably receive check. So if you have not updated your address, you might want to update the address so you don't lose your checks again, because there might be another round of stimulus like we talked. So especially if you're filing your 2019 now, make sure you're updating your address. So don't by mistake file with old address or things like that. That's mostly about the direct payments which they're giving to individuals to protect them from their job losses and all. And coming to the next one, which is extended unemployment benefits. Basically, in this area, what they did is they were allocated $250 billion to use that money to give more weeks of unemployment benefits, and also on top of whatever state pays today, they added $600 per week. So if you had income in California and you applied for unemployment, the maximum you can get is $450 per week. But with this extended unemployment benefits, they add another $600 per week. So that is from April to July timeframe. So if you applied unemployment, you should have received additional $600 per week. And that is extended unemployment benefits. The third important thing, of course, I put only few here. There are several other things which are in CARES Act, but these are most relevant for our discussion right now. The third one is use of retirement funds. Somebody, let's say, who are affected by COVID, they have an option to tap into their retirement account and make a penalty-free withdrawal. So basically, you can take up to 100K from your retirement account, and you can avoid paying the early withdrawal penalty. So usually when we take out funds from a retirement account before 59 and a half, we need to pay 10% penalty, which you don't have to if you take under the CARES Act. And of course, you still have to pay taxes because 401k is a tax deferred account. But you can also pay taxes over the next 3 years. So you can spread the tax burden over the next few years. You don't have to pay all the tax in the current year if you take the money, but you have to take it before end of this year. The fourth one is the 401k loans. Usually you can take a loan in a 401k up to 50K or 50% of your account balance, whichever is lower. But with the CARES Act, they extended or they increased the loan amount to 100K. So you can take a loan of 100K and you can pay it back over 3 years. You can spread the payment back to the 401k. So that is another thing which they added. And also they added something charity. Usually charitable deductions are in Schedule A. And given which we are going to talk in the next slide, TJSE, which is changed the entire way we file taxes. 70% of the people in US fall under standard deduction. So that means really if you do charitable donations, you may not get break. But with this CARES Act, we changed that charitable donations and put it into outside the itemized deduction. So you can get benefit out of that. The other major piece of the CARES Act is the small businesses relief. Basically, they introduced several loan programs and grants for small businesses, so that way they can keep their employees and the economy intact. So there was PPP loans, which is a Paycheck Protection Program, and there are also EIDL. There are two types of loans which they introduced majorly in this. And of course, there are a lot of things went around these paycheck protection programs, how they implemented. There were some controversies that initially the funds ran out very quickly and they added more funds to it, but now there are still funds available. And what people don't realize is when they think small business is, okay, somebody has a corporation, but small businesses are as small as an individual who is working on contracting, or a self-employed person is eligible to do are eligible to apply for PPP program. We've seen so many people not applying thinking they are not eligible. So you can, if you are a self-employed person and you had a profitable Schedule C on your filing last year, you might want to explore that. Or if you have a small partnership, you can now, based on the K1 distribution, you can apply for PPP program. So any questions, you can feel free to contact us, or you can reach out to your CPA or accountant, whoever you file taxes with, and they should be able to educate you on this. So Ajad, can you go to next slide?
So Sanjay, I'm getting some questions on the YouTube channel. Do you prefer to ask the questions at the end, or
we can address now if you want to?
Okay. I have a couple of questions here. Question one, spouse got an SSN in 2020. Should the joint returns for 2019 be filed with the spouse SSN or TI?
You should, once you have SSN, you should use SSN. It doesn't make sense to use ITIN. Though you didn't have a SSN last year, you can still go ahead and use SSN now. Only thing I suggest is if you just got the SSN, you might get a rejection initially because SSN records don't get updated with IRS right away. So probably you might want to give a week or two before you e-file the return, so you should be fine there.
The second question is,
and
can we
yeah,
use...
and especially, sorry, and especially given that you need SSN to get stimulus, you should go and apply with SSN only tax filings.
The second question, can we use retirement funds like CalPERS as well, or is it restricted to 401k only?
I haven't gone into that details myself, given I'm in the busy tax season. But as far as I know, 401ks and probably IRA are allowed. But even that should be considered a retirement plan. So they might extend or expand the definition, IRS. So it's one thing Congress passes something, and the other thing IRS has to finally come out with what they think it is, right? So we have to see what the regulation says.
Third question, is there an eligibility for 401k or retirement fund withdrawal without penalty?
What was the question? I didn't get.
Is there an eligibility requirement for 401k or retirement fund without withdrawal penalty?
Yeah, the definition is very broad, I would say. They said whoever is impacted by COVID. So that can be pretty much everybody, I would say. Yeah. So again, we don't know what IRS would interpret it as. But again, it's all subject to audits, right? There is no way for them to know whether you got impacted or not. So I think it will be an easy one to pass this criteria.
it is in respect to only COVID, or before COVID, there are a couple of criteria. Maybe you can mention that.
Again, I didn't go details of that, but usually the CARES Act said it's due to COVID, whoever is affected by COVID.
Okay, fine.
But if you are not affected by COVID, there are of course always there are some criteria which you can use to take money from your 401k penalty free. Yeah, those are medical emergency or job loss, higher education. There are certain criteria which you can use to take money out of your IRA or retirement accounts without penalty. Yeah. Like hardship rules. Yeah.
So that's all we have.
Sure. So we can go to the next slide, which is also very important, the Tax Cuts and Jobs Act. This is what Mr. Trump, when he came to office, he overhauled the tax law. So it in fact changed the way we do tax returns quite a bit actually. So previously, a lot of people with home, especially in California, the mortgage we pay, most people would be itemizing to take mortgage interest and property taxes. But with this increased standard deduction, so basically we used to have a standard deduction of 12,000 if you are married and 6,000 if you are single, around that range. Now they kind of doubled that. So, and what they did is they removed the personal exemptions. So they kind of combined these two and made the standard deduction bigger. So to make the tax code simple, and so what happened, more and more people now fall in standard deduction. At least 70% of Americans now file their return as standard deduction. But what people don't realize is, okay, now that my deductions are not enough, and so they totally ignore inputting into the tax software. But what they don't understand is California didn't comply or did not conform with the federal tax code on this thing. So even if you are in standard deduction in federal, you might be still benefiting by doing itemized deduction on the state. So from a tax preparation point of view, you should always input everything and see how it comes out. So it might still be beneficial for you to input everything, and you might get a better deduction and a better refund on the state. But yeah, due to this thing, suspended personal exemptions, if a family of let's say 4 dependents, for them this is a loss because now all they can take is the 24,000 standard deduction, like a family of 2 dependents. It's the same thing. But with the exemptions, they used to get 4 exemptions instead of 2. And the next thing is, like we talked, they put a cap on the state and local taxes that you can take as a part of your itemized deductions. And in California, we tend to pay quite a bit of property taxes. So that also falls in this bucket. So when they put cap on state and local tax, we pay enough in state taxes. So that bucket is completely taken by state tax itself. So now property tax pretty much is like useless. So whatever we pay, we're not getting any break on it. So what happened is when we started doing returns after the Tax Cuts and Jobs Act, what we noticed is, in fact, people who are making like 400, 500K in California are the ones who benefited under this act because of removing AMT. But people who were making like 150, 200 and their major deduction was home, they are the ones who lost. They ended up started paying more tax. And reduced mortgage interest deduction limits. This is another one that part of Tax Cuts and Jobs Act, which is previously we could deduct interest paid on a 1 million mortgage and 100K home equity on top. So 1.1 million, whatever loan you have on which you could take the interest deduction on. But with the Tax Cuts and Jobs Act, now that's dropped to 750K for whoever buys a home after December 15, 2017. So if you have a bigger home or a bigger mortgage, you're supposed to prorate and take only a portion of your interest deduction. So what I saw is over the years doing returns. Previously, home was a major big deduction you would get, but now overall you might save like 7 or 8 thousand in federal tax in a best case scenario for owning a home. So which is way lower than what we used to get a home break or home tax break. So the other changes they made in the which are major. Of course, there are a lot of changes. The law itself is like hundreds of pages, and then IRS interpretation. But this is mostly I put for individuals again. So there are changes in terms of how alimony is treated, and also they removed the moving expense deduction, which was if you moved on job and you could have taken job-related move expenses as a deduction, that's gone. But again, it's for state, it would still be there, but federal, it is no more. It's suspended. And then, of course, the estate and gift tax exemption, which anybody can use during their lifetime, is increased to 11 million per person. So that's a huge increase there. Did we get any questions on this topic?
Yeah, there is one question. Are property tax and state income tax are considered under same cap limits for itemized deductions?
Yes, that is why if somebody is paying, let's say 15,000 in state taxes already, they cap the 10, so its property tax doesn't make sense for federal at least. So we can go to the next one. Again, I'm touching. Yeah.
Sanjay, I have a couple of questions, sir. With this COVID for the last 3 months, a lot of people are working from home. So how does that help from the point of taxes? Can they claim home office deductions for these 3 months or extended period of time, especially when companies have said you can continue to work from home?
Yeah, always job-related expenses. People would say, "Oh, I'm working from home. I want to take the home office deduction." But the rule was, okay, if your employer had a local office and it's only by choice you work from home, you're not allowed to. But now we are not working from home by choice, right? We are forced by the situation, so we should be able to. But what happened is one of the things in the Tax Cuts and Jobs Act, there is no more job-related expenses. So if you are a employee working from home, unfortunately, you can put, but it won't make any difference because that is suspended again, that section.
So as an employee, even if I'm working from home, I don't get any benefit, is what you're saying?
Yes, on the federal return for sure, because it is suspended, that section. No more, we don't have any job-related expense section for federal under the Tax Cuts and Jobs Act.
No, too bad. Okay.
So I have one other question. Certain deductions were reinstated after 2018 filing deadline. Does it make sense to modify tax returns for 2018?
Yes, yeah. In fact, if I remember, there were changes in how retirement plans are handled. Those things, yeah, would make sense for some people to go back and amend. Okay. So now let's jump gears and try to do a little faster. Some of the slides, basically, these are more generically, yeah, in the tax code, what we have, real estate tax breaks. We just talked, used to be a big break, primary home. We used to get a tax break on home mortgage, property tax, and PMI. PMI is for, again, primary mortgage insurance, but that would benefit only if your income is low. But these were the breaks we used to get. But now primary home is not so great break for you. But rentals have always been, and I am a strong supporter of owning rental properties. The reason because as a rental property owner, you have all these various expenses you can take against this rental income. So if you see, you can deduct mortgage interest. We don't have any cap of 750K or a million when it comes to rental. If your rental has a loan which was taken to buy or improve that rental property, let's say you have a 1.5 million loan, you can take all the interest of that 1.5 million against the income. Property tax is same thing. You can take an entire property tax. There are no caps. Insurance, management fee, repairs, anything and everything you can think of. Every time you spend something, am I spending with respect to that rental, can become a rental expense. The beauty of a rental property is here, the last one, depreciation, right? Basically, if you own a property, let's say in California, we have what, 70% land, at least 30% construction cost. So you can depreciate the construction cost against the rental income over 27 and a half years. So that means pretty much it's like a expense which you are really not incurring. So it's kind of using the depreciation to offset some of the rental income. That's like putting tax-free money in your pocket. But the downside is if you ever sell this rental, then you have to recapture the depreciation. That means you're giving up your tax breaks. But if you keep this during your lifetime and leave it as inheritance to your kids or whoever you want to pass it on to, then at that time it gets stepped up basis. So that means they don't have to recapture the depreciation. You bought a property for $1 million. You have 700K land, 300K building cost. You wrote off 300K over the life of your owning the property. So it's kind of, you got 300K tax-free money, and now you leave this property to your kids. Let's say it's $2.5 million worth at that time. The basis becomes 2.5 for them. So if they decide to keep it, they can keep it and start depreciating again, or they can sell it and don't have to pay tax on any gain. But if you sell it on your lifetime, then you have to again recapture the depreciation. So the best way to build a retirement portfolio, I feel you should have one or two rentals. Start early if you're young and let them pay for themselves over the years, and eventually they become expense mortgage free and start giving you income in your retirement. Again, the other part is when we buy the rental, we lock the interest rate. So 30 years from now, with inflation, the payments would look like small, but your rent keeps going up with the inflation, right? So in the beginning years, it might be cash tight, but over the years, it makes much more sense to hold the property. That's
makes
at the high level.
Yes, Sanjay, very good point. Once again, all the audience attendees, if you have a question, type it in the chat. We will read it out so that Sanjay can answer. Sanjay, I have a question on this. The nuance of how do we capture this depreciation, or what is the impact? Say somebody bought a home at a very high price, primary home, and then they moved out, especially during the housing meltdown, to a different location, but retained that property and rented it out. So when the property has become an investment property, the value is much lower than what actually was bought. So for the purposes of this investment depreciation capturing and calculation, will the IRS consider as the acquisition cost of my investment property as my original cost, which I paid very high, or the price at the point of conversion of from primary to investment home?
Yeah, it's the lower of the two, unfortunately. So if it has gone down in value, then you have to take the fair market value at the time of converting to rental as cost, and then use a portion that again for land and building, and that comes out for the building. That's what you have to take the basis for depreciation.
And if you convert back it into a primary home at a later date, then what happens?
But this depreciation that you took will always be there. Eventually, if you ever sell, then you have to still recapture the depreciation.
Whether it has
once you put it back, once Yeah, once you put it back as primary, still the depreciation break you took is there on the side sitting there. So if you ever sell it back as a primary home, still you get that 500K exclusion, but you have to still recapture the depreciation.
So whatever depreciation that we are calculating, that would be deducted from your the benefit you get as a primary home disposal?
Yeah, yeah, and you have to pay depreciation recapture the tax rate on that.
Interesting, complicated and interesting. Okay.
Okay, I have a few more questions here.
Go ahead, sir.
Sure.
Is there a link or details on estate and gift tax exemption for reference? If there is, please share after the webinar.
Sure. I don't have anything handy, but if you can shoot an email to us, we will certainly be able to forward something on that. Yeah.
Okay. The second question is, company has local office. However, company HR has directed to work from home. Will that change?
In the old law, like I said, yes, if company says you to work from home, that means it's not by your choice, so you should be able to.
The third question, is there a limit on how much deduction can be taken for rental property?
Deduction for which one, mortgage or property tax? Usually, no. Only time there could be is, okay, you bought a property, you have a loan of, let's say, about $1 million property, you put 25% down, which is typical for a rental, 75% loan. So 750K is your loan. Your property appreciated. Now you take and increase the mortgage to 900. Then you can deduct the interest that you have taken on the extra cash out. It all depends on what you did with that money. Not just because you took it from real estate rental that you own doesn't mean you can deduct that interest on that rental or against that rental income. You need to trace that money to what you did with it. If you bought another rental, you can deduct it on that rental property. But if you go and use it to put as a down payment for your primary home, yeah, that's not deductible. Or rather, you can deduct it under the primary home rules. Right? So it all depends on what the money is being used for than where it is coming from.
That's an interesting point.
Okay. The other question I have is there a limit on number of rental properties that we can give to the kids to avoid tax?
There is no limit. The limit is the thing which we talked, that estate tax lifetime limit, 11 million, right? So the total value of assets you give is 100 million. The first 11 million is exempt. The remaining 90 million will be taxed to your estate. But at the same time, if you pass all the thing as a hard real estate, how would they bring the money to pay for the estate tax? They might have to liquidate some real estate.
Okay. So that's all I have.
Okay.
Okay, I have a question, Sanjay.
Sure.
The question is, can you discuss the implications of second home sale, especially if you own the home, but your parents lived there and you sold it after they moved in with you, no rental income on that?
Yeah, if you own the home but you never lived there, there is no primary home exclusion. So any gain would be taxed to you.
But there's no income, or we didn't do anything is what it says. No rental income or otherwise.
It doesn't matter. Primary home, even the home where you live, if you make a gain of 800K, the first 500 only is exempt. The remaining 300, you still have to pay tax on it.
Correct. But
if you lose money on a personal property, like primary home goes down in value and you sell, unfortunately, that loss is not deductible.
What about the secondary home? Basically, you can have a secondary home which is not an investment property, right?
Yeah, but the rule is simple. If you didn't live there 2 out of last 5 years, which is the case which we are talking here, then you have to pay tax on that gain.
And if you lived part of, say, in the last 5 years, you lived for, say, a couple of years, 2 years, then
You can take the up to 500K gain exclusion, subject to you didn't do that exclusion in the last 2 years. Every 2 years, you can do on one property.
okay. So I can live in a secondary home while I have my own primary home, either because of my work relation or otherwise, and I still get that benefit.
That would be tricky because primary is usually only one home at any given time. Can't have two primary homes.
Okay, this is a secondary home.
Yeah, so that can never be primary. Primary is pretty much where you get all your mail. So there are certain criteria where you generally see your doctor in that area, right? So that's how they see it.
Okay, a little tricky. We need. Okay.
Yeah. So this is all subject to interpretation at that point. Yeah.
Okay, let me go to the next one.
So Sanjay, I have a couple of questions that came in. Regarding rental income, is it okay if with all the deductions, rental income becomes negative? Do we get benefit of loss tax?
Good question. Due to lack of time, I didn't go in detail, but yeah, rental losses are called passive losses. If somebody's income is less than 150K AGI, then they can use these losses to offset the active income or the W2 income. But if for somebody, which is common in California, to have income more than 150K, these losses become suspended and they stay in your return and keeps accumulating. They will come into play when somebody sells the property, or at some point we talked, right? 10 years or 15 years from now, you paid off your mortgage, your rent keeps going up, then what happens? Positive cash flow. At that time, these accumulated losses will start offsetting the net income that you're going to get at that time.
Yeah, basically you accumulate the losses in Schedule 16 or something like that. Okay.
There's a form 8582. That's where it keeps accumulating.
Okay.
So yeah, are there more questions? That's only.
I don't have any. Go ahead.
Yeah, go ahead. I will.
Yeah, next one I thought of importance are which we talk all the time is foreign financial assets. Most people, we being immigrants, we have these things back home, or we still keep something there. So this is where one should be educated, because the penalties surrounding this area are very, very high. If you have any foreign income, you have to report, like we talked rentals. If you have foreign rentals, same thing, no different. Just because it's in a foreign country, you don't have a option to exclude that income. Or even if you have income but you have expenses enough to write off the income, you still have to show it. For not showing, even though it is a lost property, the penalty could be up to 50% of the property value per year. And they assess this up to 6 years, so that means you can lose up to 300% of your property value. Apart from this, basically interest income, dividends, whatever kind of income you have, basically U.S. tax return when you are a resident. Again, question comes all the time, okay, I'm on H1, am I supposed to show my global income? Yeah, you're no different than green card holder or citizen. Anybody who files a 1040 series, not 1040 NR, has to show worldwide income. So that includes all types of income, interest, dividends, capital gains. If you have mutual funds, that itself is a different ball game altogether. But you have to educate yourself in this area if you have foreign financial assets. And apart from showing the income in the return, there are other reporting requirements where one has to file FBAR, foreign bank account reporting. It's a government website on FinCEN where you do this. If you have combined foreign financial assets all put together more than $10,000, which is 7 lakh INR or whatever currency your assets are in. If that combined value is more than 10,000, even for a single day, you have to file this form. And the deadline is same as tax filing, and used to be a different deadline, but now it's changed. And for somebody who has even bigger financial assets, like more than 100K or 150K anytime in the year, or 100K on December 31st, if you're married, and if you're single, those thresholds are cut to half. So you have to file something called 8938 or FATCA. These are more detailed for all your foreign financial assets. That's part of your tax filing itself. And you have to tell where you're reporting that income on the return in this forms 8938. Apart from this, other major reporting requirements in this area are if you ever receive foreign gifts or inheritance, there are certain thresholds for foreign gifts or inheritance above 100K has to be reported in a form called 3520. Not doing it carries severe penalties again. And if you own a foreign corporation or a part of a foreign corporation directly, you might have to file 5471 depending on the situation again. And if you missed or where you were in compliance in all these areas in the past, there are some remedies here. The most popular one is streamlined filing. That is for people who missed or are doing things due to lack of knowledge. But you have to certify that this was all due to lack of knowledge. Then you can go through the streamline program and pay some penalty, do some amendments, and come out clean. That's a little bit overview of this area. So just to educate you, so you can start exploring if that's something of importance or that applies to you.
Okay, I have a couple of requests. Can you shed light upon international property inherited from parents and tax implications in general at high level?
Yeah, basically, if you inherited a property, whether international or US, the law is, we talked, right? The inheritance gets stepped up basis. So if you inherited the property, one, you have to report that as a foreign inheritance if it meets that threshold of 100K. Apart from that, I would suggest if you inherit something, get a valuation at the time you inherit, because that becomes your basis when you eventually sell it. So when you sell, you can use the step-up basis as your cost basis, so that reduces the gain. But if you get as a gift, then you carry the original owner, whoever gifted it to you, their basis becomes your basis. So you don't need fair market value valuation and all. But the next thing you should look at is, okay, when you sell the property, you would pay tax in that country, and then you would have to report that gain again here. And then, especially, for example, with India, the law is so different. The way the gain is calculated there is different. The way gain is calculated here is different. But once we understand what's the gain to be reported in US, we can take credit for the taxes paid in the foreign country, because now it's being double taxed in both the countries. But that's federal, right? Then when we come to state, there's no foreign tax credit, so you end up paying whatever, depending on your income, anywhere up to max 10%, 12%, you might end up paying California taxes, and you don't get any credit for foreign taxes, obviously.
Okay. So the other question is about LIC policies at maturing. Indian tax is exempted, but
yeah, for US taxes, it's not exempt. So whatever money you receive when it matures, minus whatever you put in over the years, that's ordinary income. So you have to report that.
That's all I have.
I have a couple of questions, Sanjay.
Sure.
So you said any gifts that are given should be declared if they are above 100K. So every year can gift be below 100K and you don't need to worry about reporting?
Yeah. But I would say keep a gift letter or a deed, whatever you create in India, in your records. So if you ever get questioned, you can show proof.
So basically, typical challenge is the grandparents giving money for the kids' education here in their undergrad or master's. So they can send money there up to about 90 or 95K for 2 kids here. And very well, they keep the letter grandparents to the kids' education. They don't need to worry about reporting.
Yeah. And I think if they directly pay to college, I don't think this limits will apply. So, or rather, this reporting requirement might apply.
Okay.
Only if it comes to them personally.
Okay. And I have one question here from Sri Harsha. I have an in-laws unit in my home, and if I am renting it out, will I be able to exclude 500K for when I sell it? Or do I need to prorate the income and do that?
Yeah, you might have to prorate because that part is considered, or the percentage of that is always been a rental property. Yeah.
Okay, so right out of it, you will not be getting 500K, but whatever the proportionate of it, you will be reducing from 500K is what you're saying?
Yeah, like let's say 25% is the in-law unit, 75%, and you made a 400K gain, then 100K gain could be taxed, 300K would be excluded.
Wow, okay.
But this was the case used to be for home office used to. If somebody said they were using the home for work related and they were taking depreciation and all, but at a later point IRS gave a ruling, but if you claim home office, you can still claim the entire 500K exclusion. You don't have to prorate it. That's for home office use only, but not for in-law unit rented out.
Okay, good to know. All right, so we don't have any other question. Let's go to small business.
I like this crowd. They are pretty good questions that I'm getting. So yeah, this one I just added. If maybe some small business owners are here, so who has a small company or something. So we talked about home office for employees may not work, but home office for businesses is still a good direction, right? So if you have a area allocated and dedicated for your small business, yeah, you can take a portion of that as a home office deduction, given especially now with TJC so much limitation to take it as a primary home. Why not take a portion of it as your small business deduction? Then, of course, the most important and common question we get is auto expenses. Can I take actuals, or when should I take actuals, or when should I go for standard mileage? I would say if you are driving a very expensive car and putting only less number of miles, actuals might come out better for you. But if your business, you're driving a much less expensive car, but you put a lot of miles, standard mileage will be the way to go. So each case is, we have to see what makes sense for the person and then make the choice. And then you have these business meals and entertainment. Again, with TJC, a lot of changes in here, which used to be deductible expenses have become non-deductible. You want to look at those. And also Section 179 is a very good deduction where you can write off business assets in the first year. So sometimes under this, people buy Tesla Model X and take this deduction, which can be a significant tax break. But again, it all depends on how much revenue you have, what expenses you have to take that kind of a big deduction in one shot. Same thing, bonus depreciations. Then you have employee retirement plans. I've seen a lot of people with small businesses not taking advantage of employee retirement plans. So if you are self-employed, you can do what most employees do, 19,000 or 19,500 for 2020 as contribution. But you can, as a business owner, your business can do profit sharing to up to 25% of salary, and also that's a huge tax deferral there. So these are some of the things which I would just want to touch upon. But of course, it's common sense. Every time you have a small business, you spend something, you want to think, okay, is this something I can claim as a business expense, or it is related to my business? Or does it make sense in my line of business to be a business expense? So that's where it goes. So it's like a filter, right? First you think that and then go to personal expenses. So if you go buy all together for your business and personal, separate them, have separate bills, keep the bills. Record keeping is the key end of the day. Yeah.
Can you throw some light for the small business owners, especially the long-term care insurance is 100% tax exempt? How can they leverage that for their family members using the small business, opportunities? So I know, like, I can, each member of the family can contribute some number of hours and then I can pay. Can you throw some light on that?
Yeah, basically, if you have a business, you can employ your kids, and even if they are 17 or 18 in college, you can employ them and pay them. Given we thought the standard deduction is 12,000, so that much amount can become tax-free for them by filing their own return. The first 12,000 is exempt from taxes, so you might be in a very high bracket, so that will save you taxes by having them employed in your business. And we recommend after employing them that whatever the tax-free money to put in Roth IRA. And given they are so young, they have so many years to grow that money tax-free. So by the time they hit retirement, that money can grow several times, and all that comes out tax-free.
And so, do they have time now till July 15th, or it is expired at April 15th to open the IRA?
For IRAs are on July 15th now. Yeah, even HSA, same thing. Whatever deadlines were for April 15th got changed to July 15th.
Okay, so technically, so anything you want to do, all the contributions you have till July 15th.
Yeah.
But if you file for extension, the deadline is only July 15th.
For IRA and these things, yes. But if you're a self-employed person, SEP IRA, that gets extended to the extended deadline, whatever you do.
Okay, excellent. I just saw a question come through.
I have one question that came through here.
Go ahead.
If parents paid the premium for LIC policy in our name and the policy matured and sum is deposited in our account, how to calculate the tax on it?
Who is the owner of the policy? That's the question right here. So if they are the owners, it's their income. But when it matured, it came to your account. So what does that mean? It's their money you received. That means they gifted it to you. So you might want to see, maybe you might have to report the foreign gift if they are in India.
Our name. If my dad is, or my parents are paying it for me from their income, but it is on my name.
That's what it could be, your name. Who the owner of the policy is what matters. Means who gets, what does the policy say? Who gets the money, right? That's the thing. I can be insured, but somebody gets the money. Okay. They took policy on my name, so it's pretty much their money. They insured on me. So that's the key here. So, but if you are the owner of the policy and they are paying, that means when they are paying, that is gift, not when the money is coming out.
So as long as it's like, the owner.
Okay, let's say I'm the owner of the policy and somebody is making payments on a regular basis, that means I'm getting that regular gifts from them.
Yeah, makes sense. Basically, owners get taxed and we get this as a gift. Okay.
Mm-hmm. Yes.
Second question. Is there any tax implication or have to disclose anything to IRS state being part of a non-profit organization as a member or a volunteer?
You don't have to do any special disclosures, but yeah, if you get income from that, yeah, that income would be taxable if you're on the payroll of the non-profit or whatever.
Okay.
I have one question. Do you have any more, Randy?
Yeah, there is one.
Okay,
if you haven't filed or missed F-bar for previous year, any particular action needed to be taken?
If you missed only reporting of assets, but you've been showing the foreign income, you can file delinquent F-bars. No penalties. You just go back and file those delinquent F-bars. But if you missed income, that is where you need to go through the streamline process, which we talked.
So that's all I have.
Sanjay, I have one question. It is, what is the minimum age for contributing to IRA? And basically, who can contribute to IRA?
Anybody who makes that money, basically, right? If my kid is not earning, I can contribute 5,000 to him. It should be his earned income to contribute to IRA. So the age limit is, end of the day, is he working? Is he allowed to work legally? That's something we have to check the labor laws. So, are you, in case of California, I think you need to take permissions from school if your kid is so young. So, those are things you have to see. But once if you go through all that and you make sure he's allowed to work and he works and makes that money, he should be able to do IRA.
And if there is a 401k offered in the employment place, can they still open an IRA?
That depends on the income. End of the day, if somebody making 100k or in that range, and if they do have 401k, still they can do IRA. But if somebody who is making 200k and they do participate in 401k, even if they participate and just put $100 in 401k, they are ineligible for doing IRA.
Can you repeat that once again?
So it depends on the income. Somebody with a low income, even if they do 401k, they can still do IRA. But for people with higher income, even if they do a small amount of 401k, they become ineligible to do IRA.
Okay.
I have one question that came in. Should FBAR be filed if income from India is less than taxable income in India?
Yes, FBAR has nothing to do with income, first of all. FBAR is more to do with balances of the accounts. Combined value of the foreign financial assets is more than $10,000, you have to file FBAR. You might be getting, it's not even balance sitting there, right? I move money from here to my foreign account, the money went out immediately. I didn't get any income. But it crossed $10,000 on a given day, you have a FBAR requirement.
Okay, I have a question here. I think it's more to, the question should be more to the immigration rather than tax. I don't know. With the H-1B permit, can I run a business? If there is a restriction, what is the solution?
Yeah, if I answer that, it will become me practicing law without license. As a CPA, I'm not supposed to answer that, even though I might know the answer. So I'd rather skip that.
Okay, so there is no answer from your side, is what you're saying?
But theoretically, you can. There's nothing stopping from owning, right? If you think like owning a business is like owning shares of any company. Can you be on H1 and buy shares of Cisco? Same thing. You can own shares of any small corporation too. But are you actively participating in the company? That's a different story.
Okay, so it is about running day-to-day, compromising your status vis-a-vis just owning.
That might be a problem, yeah.
Okay. One more question. Could you please clarify on IRA, you mean traditional or Roth? I think employer supports 401k people are eligible to contribute to traditional IRA, not eligible contributing to traditional IRA. Let me repeat. Could you please clarify on IRA? You mean traditional or Roth? Roth IRA. I think employer supports 401k. People are eligible contribute to traditional IRA.
No, maybe I think what they're trying to ask is, okay, if somebody participates in 401k, they may be ineligible for IRA, but they can still do Roth, yeah. Even Roth has some AGI limits. You can do Roth after certain AGI, but there are indirect ways to do Roth, which we call backdoor Roth. You can first do non-deductible traditional IRA and convert to Roth. That still is an option for everybody.
Okay. Okay. If there are any more personalized questions, probably they can reach out to you. The question, as a H-1B holder, I will be a passive partner. Is it okay? Is what the question comes through.
That's what we just answered. Yeah, as long as you're owning ownership, that's all. Yeah, why not?
Okay, as long as passive partnership, that should be fine. Is what I understand. Okay.
Mm-hmm.
A couple of questions that came in. So it is again, can you give some idea on backdoor IRA? And second one is income limits for family and individuals on for IRA.
Yeah, income limits is something you can find easily. I don't try to remember numbers because that's where I rely on software. I only try to understand the code, so I know when to rely on the software. Roughly, they are like around 190K AGI if you are married, that you become ineligible for doing IRA. But again, I can check. Those are not of importance. So, but what was the other part of that question?
Give some idea on the backdoor IRA.
Yeah, backdoor IRA. Basically, backdoor Roth is we have AGI limits to directly do Roth, but there are no AGI limits to convert traditional IRA to Roth and pay tax on it. So since there is no AGI limit on converting, so you can first contribute to a non-deductible IRA, and even non-deductible IRA, which is putting money in a traditional IRA, post-tax, there is no AGI limit. So you always enter traditional IRA as a non-deductible IRA. You don't take a tax break. Now you have this after-tax money sitting in a pre-tax account. And since they said there's no AGI limit to convert the traditional IRA to Roth, you can next day go and convert the traditional IRA to Roth. And that's the indirect way to get into Roth. But of course, there are certain limitations. If somebody has a big chunk of money, let's say sitting in a pre-tax account IRA, now they put the 6,000. They can't say, "Oh, I'm just moving this 6,000." You have to treat that entire thing as one big IRA. In that, you have this 100K tax deducted, and then the 6,000 post-tax. You move 6, it comes accordingly from that big pool of money. So you have to allocate from the pre-tax and post-tax, and you end up paying taxes. So to do this backdoor Roth, you should not have any pre-tax IRA to not complicate your life. So if you have any big pre-tax IRAs, 2S1, you have to clean it up by either going to Roth one time, pay tax on it, so you can keep doing this backdoor Roth. The other option is you take this pre-tax IRA into your existing 401k, clean up this pre-tax IRAs. Now you can start doing backdoor Roth.
That's all we have.
Yeah, I don't have any here.
So we still have some time to go over the slide, right?
Yeah. We have another 20 minutes if we don't have anything else. Yeah.
Okay. So the other most common thing in California, people in the area, some of these areas is stock options and employer stocks. Basically, you have these various ways of getting compensated. These are employee stock purchase plan, then the restricted stock units, which is more popular nowadays, and the older version of those are like stock options, IS1Q, which still some startups provide. So ESPP is where you contribute through your payroll and you get this money. So I've seen a lot of times people not contributing, but this is something you should take advantage of because this is short money, right? You get at a discounted price. So you don't have to be a serious investor to make money. You just put in and you get 15% discount. If you are not a person who holds shares, sell them right away when you receive and you still make 15%. Not a bad deal at all. But yeah, when it comes to holding them, there are certain rules around ESPP. So you might want to read what is qualified disposition and what is disqualified, how they impact taxes if you have a lot of ESPP sitting there. But the other thing is RSUs. RSUs are pretty much given to you at zero cost. So as they get vested, they become compensation. Whatever the fair market value of the vested RSUs, they get added to your W-2. So you pay ordinary income tax, and then if you decide to hold and they appreciate or they, go down, then you might have a gain or loss. This is where people tend to do wrong when it comes to their tax filing, because they always think, oh, I got the RSUs at 0%, and they report the entire sale proceeds as gain again. But you need to understand, when they've got vested, you pay tax on it. So now your basis is whatever the fair market value. So you pay tax only on the difference if it really appreciates. So given that point, is it worth holding RSUs? Maybe, maybe not. If your company, if for today I give you money to you and say you invest in stocks, is that your company stock that you're going to invest in or some other company? If you're going to say some other company, then why hold your RSUs? You can as well sell your RSUs and put the money there. So you're not going to pay any additional tax. All the tax is already paid when they get vested. They added to your W-2. They took a part of those RSUs and paid taxes. So you rather sell the remaining and put that wherever you feel like investing. Options is very two types of options. Again, there's differences in the way tax are treated for ISOs and non-qualified. So if you, which is most common is with startups is ISO, and it's a very complex area. You need to seek advice if you're planning to exercise and hold. A lot of people, they hear, oh, if they exercise, it's beneficial, and they start exercising without knowing the implications. They only know the implications, and they go to their CPA to file taxes and see, oh man, I didn't know that this was income by just exercising, and they end up paying huge tax bills. So you need to know what you're doing. Each company is different. What you see, how you feel about that company, all these things have to be considered. How long you want to hold, when will they go? A lot of things have to be factored when you make that decision. But understand what you have and try to use them to your advantage. There are cases where people got burnt with employer stocks, like recently Uber, right, or Lyft. When they went public, they were highly priced, and then they were in locking periods, so all that income on W-2. But by the time they came out of lockout, the price went down. So there are a lot of things to consider in this area. Seek some advice if needed. Yeah. I think that's pretty much I have.
I have one question here. Could you please share info on ESPP limit? Is there a limit?
Usually, most companies say 10% of your paycheck is what you can contribute to employee stock purchase plan. And then depending on how much you contributed during that ESPP cycle and the price they decide to allocate it at, you will get a certain number of shares end of the cycle.
I have a couple of questions here.
Mm-hmm.
So traditional IRA contribution without tax deduction, is it allowed beyond 119K? That's it.
That is probably for somebody who didn't participate in 401k.
Okay. So the next question, can 401k money be withdrawn with just 10% penalty in small chunks every year till we hit nil tax slab on that particular year?
No, small chunks is fine, but till what? I think the last line of that question.
We hit nil tax slab on that particular year. So probably if you have 100K, 401k.
If you really want to take out, you can spread it out, seeing where your income falls in for that extra income, which bracket it falls in. Yeah.
Okay. For rental properties, sometimes we give cash to landscape guys, handyman. Can we show it as an expense?
It's all expense.
In theory, anybody you pay, if you pay more than 600, you're supposed to issue a 1099. And of course, if you pay cash and all, you have to probably maintain records to really claim those expenses if you get audited.
Yeah, that's all I have. Okay, one second. Can you touch on tax implications of investing in Bitcoin?
It's no different than investing in stocks. So it's basically only difference there is, okay, sometimes you end up buying one coin and convert to another coin. That conversion is also considered sale. So you have to recognize the gain. It used to be not like that before, where you could convert and not pay tax, but now conversion is considered a sale, so you have to calculate gain accordingly.
That's all.
Okay, I do not have anything more here, and that's an amazing participative session we had. Sanjay, thanks a lot. Thank you very much for taking time in this busy season, and for all the participants.
Actually, it was a breather for me. It was such a good relief to see such good questions coming out from the audience from my busy schedule. This was very relieving, actually.
Yeah, it would have been good if you had a slide sharing your contact info, but if you, I will send it out to the participants so that if they have any more questions or reach out to you for any help, they can do so. And for all the participants, go ahead. And basically, this is one of the first sessions that we are going to organize in collaboration with Samasti. Samasti is taking initiative and doing this. My name is Azad, and I am helping out bringing the industry experts. We have 9 more sessions on different topics. Some of the exciting ones: finance 101 to investment to risk management to college planning, and we have estate planning, and we have social security and healthcare in retirement and its implications. There are very, very good topics that are coming up, lined up for the next 9 more Thursdays, conveniently scheduled at 8 p.m. So I strongly recommend all of you to go ahead and ensure that you attend. If you have any friends who are interested, I put in the chat that registration link. They can go ahead and register so that they get all these sessions and the best of the best. So thanks again, once again, for taking your time. Leela Prasad Garu, you have anything to share?
I would like to first thank Sanjay for an amazing session that we have here. It's really, really informative, and you have enlightened us a lot on taxes. Many of us, we just hand it over to tax consultant or rely on tax software to do the taxes, but you have given a lot of information that we can make some informative questions. We can ask some informative questions over to the consultants. This is an amazing session, and we really appreciate for taking such a long time for meeting with all our community members. That's one thing. And Azad, it's really so helpful working with you to organize, call for all the industry experts in the area to volunteer some time for Samasti and give some of their precious time to help us learn a lot about other topics. And I also want to thank the committee members of the Samasti for organizing this beautiful session and all the members who have participated. So there are many more such interesting topics that you would be learning upon, and please make use of this opportunity. Knowing and learning is completely up to each individual. Nobody, you can take the horse to the water, but we cannot make it drink. Okay, so Samasti is bringing up the sessions, but we have to show interest and we have to get participated and learn and understand the details. I really appreciate if you can spread the news and have your friends and relatives participate and learn. That would be helpful for every one of you. Thank you very much once again to both Sanjay and Azad.
Yeah, a lot of people are thanking
our
you.
pleasure, actually.
Yeah, thank you very much one more time to everybody, and hope to see you all in the next week's session. So this is Samasti, and this is me. If you want to capture any information or reach out to me, next session will be, I'll be taking the next session, Finance 101, and you have, okay. So nice.
Next session is going to be Finance 101, and that would be on July 16th, 8 a.m. to 9:30 p.m. by Azad Aramandla. We'll be having estate planning on 23rd July, again by Azad Aramandla. College planning by 30th July by Sally Wu.
Sally is a professionally trained and licensed, and she's amazing. I don't, if you have any kid who is coming up for the college in the next 5 years, I would definitely attend that session.
Retirement planning on August 6th by Azad Aramandla. Social Security on August 13th by Douglas E. Ewing. Healthcare Planning in Retirement by Douglas Ewing on August.
He's a nationwide VP, and he's very good at those topics. I strongly recommend.
Life, Disability and Long-Term Care on 27th August by Azad Aramandla. Passive Income Investment on September 3rd by myself, Leela Prasad Kaneru. And Investment Management on 10th September by Azad Aramandla.
Okay, thanks a lot. With that, we come to the end of today's session. Thank you once again, everybody. Sanjay, thank you. Much appreciated.